Good evening, everyone, and thank you for joining us. My name is Stacy Varghese, and I'm the Director of Leadership Annual Giving and Engagement at St. John's University. Today, the members of the Women's Investors Club will be hearing from Veronica Karras, who will discuss financial literacy. Some housekeeping rules before we begin. If you have a question, please submit it on the bottom right in the Q&A section to panelists and host, and they will be answered at the end of the presentation. Also, a recording of this webinar will be available to you on the Alumni Professional Development page on the university site. Now, I'm excited to introduce our speaker. Veronica joined CapTrust in 2018 and serves as a senior financial advisor. She has extensive experience working with high net worth individuals and small businesses in all areas of financial planning, including estate planning, retirement planning, tax planning, education planning, and insurance. She is also a CapTrust Community Foundation board member. When she's not in the office or with a client, Veronica enjoys helping people through transformational life coaching, volunteering at Rescue City, and spending time with her husband and her 3 dogs. Veronica is the author of the series Money Matters, including Money Matters, Everything You Should Have Learned in School But Didn't. Welcome, Veronica. I will hand the webinar controls over to you now.
Thank you so much, Stacy. It's a real pleasure to be here. I'm excited to be here with all of you, and hopefully we'll get to know a lot of you either after this call or during the call as you submit great questions throughout. That's what makes this all interesting. So thank you for the kind introduction, Stacy. So I work with CapTrust. There's actually a second member of this club that works with CapTrust, Stacy Siegel. Who I'm a big fan of. So I know at least one of the alumni members here is top notch. So I'm hoping for lots of interaction and questions as we go along here. So CapTrust is the largest fiduciary in the United States. That means that we are legally obligated to do what's in the best interest of our clients. So nothing that I talk about here today is a sale in any way. We do a lot with financial literacy work. It happens to be a really big passion of mine. And I'll talk a little bit about my background, but if you have any questions, just feel free to ask. I'm currently sitting in Port Washington, New York, really close to our office in Lake Success, New York. I have been in the industry for 14 years, starting in life insurance. I spent 6 years at a different registered investment advisor, a year at Merrill Lynch, and have been here with CapTrust for just over 6 years as well. You'll see some of my dogs walking around in the background. They tend to be quiet, hopefully, and you may hear a baby cry because I have a son that's 5 months old as well. Like I said, we're full-fledged fiduciaries. I'm a certified financial planner, but I have to give you some legal disclaimers as to what I am not. So I am not an attorney or an accountant. A lot of retirement planning, financial literacy has a lot to do with both legal and accounting advice. So just keep in mind, nothing here fits that advice type, and nothing that I'm here is actually individual investment advice as I talk through this. It's really, really general, and I'm happy to answer any questions that you have throughout or as a follow-up. So let's jump right in. The things we're going to talk about are, why does it matter that women are financially literate, right? Why is that different for a woman versus anybody else? We'll go through some financial planning basics, and then we'll talk about putting your money to work. So what are we really up against, and why does it matter that we as women specifically become financially literate and really take control of our financial lives? First is, as there's been a general shift in the marketplace towards individuals being responsible for their retirement savings. Where in the era of our parents, especially here in the US, there were pension plans and defined benefit plans that companies provided to help fund an income stream. That's no longer the case. We're now dealing in 401k, 403b world, or setting up our own businesses and SEP IRAs and other things to fund our own retirements. Social Security benefits, for a variety of reasons, mostly that women tend to go out of the workplace for some time, are typically 22% lower than Social Security benefits for men. And women live longer than men do on average, so far by only about 3 or 4 years, but I think that gap tends to extend over time. And there are continued increases in the cost of living. We're all living in a time of inflation, and it's going to affect our buying power as we live longer and earn less from Social Security. So it's really important to think about that when we think about our finances. So, we should be thinking about longevity risks. If we have lower earnings, right? So statistically, women earn 86 cents to every man's dollar still. So we have statistically lower earnings. We have caregiving demands. So sometimes women tend to be what we call the default parent in many cases. And don't go back to work, don't go back to work as quickly or have a break, which leads to some workforce absences to take care of children. We also, on the flip side, I will tell you, take care of parents as well. And I would say, in general, there is a lower investing confidence for women than for men, from lack of education and exposure and history, I would say, throughout. So let's talk about the longevity risk, right? So the probability that someone reaches age 80 or 90, for women, it is 34% likely that women will live to age 90. And in a couple, the likelihood that at least one person makes it to age 90 is 49%. So if you hit age 65 as a woman, you will more than likely live to about 85.6, right? So, and in 2018, it's actually the largest growing demographic. In 2018, there were more than 93,000 Americans who are 100 or older. And that's by percentage, the largest growing demographic of people in this country. So just keep that in mind. So we always say women earn less than their male counterparts, right? So this is sort of the total. If we had a benchmark, this is by occupation in 2014 from the Bureau of Labor Statistics, right? So women as a whole, full-time wage and salary earners earn less than men in many fields, right? So just keep that in mind. Caregiving demands, right? So we get both sides of the coin. We get workforce absences, taking care of children and taking care of parents. The average negative impact on a caregiver's retirement fund is about $40,000 more for women than it is for men. And caregiving reduces paid work hours for middle-aged women by about 41%. I'm sure a lot of you here might be able to relate to that. And the total cost, the impact of caregiving on an individual woman's caregiver is typically in total Social Security benefits over a lifetime can add up to $324,000. So again, like really big differences overall for women investors versus men. I'm going to skip over investor confidence because after this, you guys will all have a lot of investor confidence. So we're going to go with skipping over that as a cause. So let's dive right into some financial planning basics and we can go through that. So, one of the biggest things and the place you always want to start when it comes to your finances is where your money is going. You want to be really, really certain about what you're spending your money on and what it costs to run your household. So, these are just some statistics, right? 70% of Americans in North America live paycheck to paycheck. 60% of working Americans experience moderate to high levels of financial stress. And there's 40% of people who are in debt having monthly debt payments that are more than half of their income, which should be shocking to everyone, but might not be. I mean, debt is sort of the result of not knowing where your money is going and really easily gets compounded over time. So you want to be really careful and really knowledgeable about where your money goes. So the first step is figuring out how much do you really spend? What do you spend it on? I always tell everyone just track it for 1 month. It doesn't have to be ongoing, but track it for 1 month. There's a ton of apps out there now, which I'll talk about a little bit, of where you can go and get information for, how much of your money is going and where. Mint and others that will sort of automate this process for you. You want to think about where you're getting your money from, right? So pay from your job, dual income, child or family support, rental or investment income, and eventually Social Security. So related to budgeting is all of your sources of income, of course. Like I said, there are a bunch of apps you can use to figure out where your money is going. Wally, Good Budget, YNAB, which is You Need a Budget, Mint, and Pocket Guard. They also all have websites, so you may want to just consider signing onto the website, going from there. And related to that, where your money is going and making sure you have a handle on your debt is your credit, right? So you want to make sure that your credit is in check. You want to really, your credit represents your reputation as a borrower and your personal financial character when it comes to getting loans or lines of credit. And if your credit score is low, it can impede your access to credit, interest rate, or even your loan return. Or in the cases of my working field, it can impede your ability to get a job, actually. Hopefully others don't have that problem. You also want to review your credit reports annually to make sure all of the information on your credit report is 100% correct. That's how you make sure no one's stolen your identity. You can do so for free once a year. We'll talk about in a second where you go to get that, but you want to review your identification information, your account status information, your active account dates, out of date informations, and make sure there aren't any accounts that you don't own or recognize. In terms of credit scores, so you can get an understanding of how they work. They range between 300 and 850. The higher the number, the better the score. And again, it can influence your access to credit and how high or low the interest rate is that you're going to get when you're borrowing or taking out a line of credit. The way you check your credit, because I realized I didn't have that slide here, is www.annualcreditreport.com. I can type that into the little, I don't know if that'll pop up for you, credit on the little Q&A channel, or we can put it up afterwards. It's annualcreditreport.com is the official government agency provided credit reports. You can get it from all three reporting bureaus once a year. I highly recommend doing one at a time so you can actually check your credit 3 times a year for free. Hopefully that all makes sense. As I'm going along, please put questions in the chat if there are any, and I will pause and make sure I answer them. So putting your money to work. So you want to make sure, so a lot of people, not just women, but a lot of people focus on shorter term goals rather than longer term. You want to make sure as you're saving and investing that you're focusing on both. So statistically speaking, this is according to BlackRock, 61% of women follow a household budget. It's pretty low. We want to bring that number up as high as possible. And 45% of women have investments. So one of my personal missions makes that number 100. I don't know if we'll get there in my lifetime, but I certainly hope so. And so one of the biggest things that you can do as an investor is start investing right now. So let's take investor A and investor B as examples. So let's say investor A started today and they invested $150 a month into the S&P 500 for 40 years. And so their total contribution was $72,000. Investor B waits 10 years and tries to catch up by contributing $200 a month for 30 years. They got 10 years less, but $50 a month more. So they also contribute a total of $72,000. That 10 years is a $100,000 difference. So you can, if you start sooner, you can invest less, but because you have more time horizon, it'll end up being more money for you. So the biggest thing you can do if you get nothing else out of this is start investing now. It's never too early. There's no such thing. See a question here. Which website is your favorite to use for a budget? I use Mint. I don't know that it's my favorite. I haven't tried so many others. I hear really, really good things about YNAB, but I personally use Mint for managing my budget because it makes it really easy to upload all of my accounts and sync them up and everything. So that's a great question. Thank you. But this is the biggest thing is like, make sure that you are investing your money and invest sooner rather than later. And look, investing is an emotional game. It's all about your mindset. When there is a lot of excitement and thrill and euphoria in the market, towards the tail end of last year, for instance, when everything was going up, that is actually the worst time to invest. We call that the point of maximum financial risk. On the flip side, you may all be, because we are in a market volatile environment and the news can be really scary. We're somewhere between desperation and panic right now in terms of if you're following the news, what the news has to say. The best time to invest would be when things feel like they're at the bottom, right? So parallel this to something we may all remember because it's recent. In March of 2020, the market dropped 34%. March 23rd, actually 2020 was the bottom of the market. Everyone thought the market would keep going down, would go down to like 50 or 60% because the whole world was shutting down. You want to be investing. I'll talk about actually what you would begin investing in a minute, but that would be the time you want to invest is when everybody else is running away. That's the best time to invest because that's when you're investing at a discount, right? When the market is lower, you want to be sort of on an ongoing basis, buying low and selling high. So that's what this is, right? A recession is a good time to invest. That is absolutely correct. The timing where everybody thinks it's going to hell in a handbasket, that's the best time. And I'll tell you what, part of the reason it's the best time is sort of, if you think about it, like the market is on sale, right? So the market is down about somewhere between 20 and 25% since the beginning of the year. Let's call it 25%. Even if the market goes down another 10%, you will have bought in at a 25% discount. And so when the market starts going back up, you end up getting back that much faster, right? So by the time the market is back to where it was, let's call that zero, right? Or let's say it goes back to somewhere around here on this chart, you are actually up 25% from when you started investing. So a good time to invest is absolutely at the bottom. If we could all call a bottom, we never know when it is because none of us have a crystal ball. The best time to invest is when things are all the way down as low as possible. You just have to have the emotional sort of strength to do it, right? It ends up being really hard to do that on an ongoing basis and systematically without that. So what's the best way to catch up is something that somebody said. It's the best way to catch up is actually invest significantly more. So someone, hopefully a registered investment advisor or fiduciary, and I can certainly put my contact information here, share it with you, or Stacy can share it, could run a projection for you of how, if you haven't been investing, how much you need to invest on an ongoing basis to catch up. Hopefully that helps and answers that question. Awesome. So this is sort of to the point of the question of what would you begin investing in. This is a chart showing all of the different or a myriad, it's not all of them, different asset classes. So each color is a different sort of type of investment. So I'll start here in 2008. Fixed income is purple. So all of the purples that you see here is the performance of fixed income in each given year. Red is cash. This teal color is large cap growth stocks. This sort of grayish color is mid cap growth. This dark blue is mid cap value. And so hopefully you can see on this chart between 2008 and the middle of 2021 that there isn't any one asset class that performs the best over time every single year. And so you can see so for instance, in 2020, the best, and 2019, the best were large cap growth stocks. But actually, they were near the bottom in 2008, and often even in 2012, and again in 2016, not that high up, right? So you wouldn't want to have all large cap growth stocks because, and especially in a year like this year, they would be down. So the best thing to invest in is a well-diversified portfolio. Saying it differently, you'd want a little bit of everything. If you were just getting started, you would want something that has broad access, like a total stock market fund and a total bond market fund, for instance, and then some cash on reserve to pay for your expenses. But essentially, you'd want to have a little bit of everything so that what you end up with over time is middle of the line returns. And that way you're never taking on too much risk and you're never trying to time the market, because that's sort of a fool's game. Hopefully that all makes sense. Time in the market is more important than timing the market. Promise I don't have a lot of lines, but that's one of my favorites. So this is returns from 1987 to 2020. So if you were invested the whole time from 1/1/1987 through 12/31/2020, you would have gotten an annualized return of 11.42% if all of your money was in the S&P 500 index. If you missed just the best 20 days in that entire 24-year period, you would have cut your returns to 7.1. And if you missed the best 50 days of that, again, that entire 24-year period, you would have cut your returns down to 3.14%. So the lesson in this is invest as early on as you can, and stay the course, whatever happens in the market. Because there was a lot of market volatility between 1987 and 2020, right? You had the correction of 2001. You had the recession of 2008. The market was down in 2018. The market was down again in the beginning of 2020. Through all of that, you would have had an annualized return of 11.42% if you just stayed the course and didn't touch your money. So make sure you are spending your time in the market and not spending your time timing the market. That's super important. This is just a chart of historical performance. This is S&P 500. So the S&P 500 is the Standard & Poor's 500 index. It measures the performance of the 500 largest U.S. companies. These are rolling 10-year returns for all the years ending 1980 to 2020. You can see there's just 2 negative 10-year periods in that entire 40-year ongoing 10-year cycle. So again, just invest early, stay invested, and be diligent about it. Add in money whenever you can and keep rolling it through. Investing is the way you increase your wealth. So let's say you had $10,000 in July of 2001 and you invested it and kept it until June 2021. If you had it in cash, your $10,000 would be about $12,500 based on interest rates during this time. If you had it in a 60-40 portfolio, so that's 60% in stocks, 40% in fixed income, your portfolio would be about $47,000. So quite a big difference there. You definitely want, and you could see there are times where the value dipped below cash and even dipped below the initial $10,000 investment. But over time, over this 20-year period, you ultimately made a huge amount of money, right? Hopefully that makes sense. So let's talk a little bit about sort of the basics. I've thrown around some terminology here, so I'm going to backtrack a little bit and cover it. Stocks are ownership shares in a company. So when you're buying Amazon stock, you're actually buying one share of owning a piece of Amazon. Bonds are debt. So you're actually making a loan to a municipality, a corporation, a government to buy their bonds. So let's say if the US is trying to build roads, has a roads or a wall or anything else the US might be building, they issue bonds. They're actually the largest bond issuer in the world. And what that means is you can buy up US Treasury bonds, and they go on for a certain time period, 3 months, 2 years, 10 years, 20 years, 30 years. And at the end of that term, you get your money back. And along the way, you get a promised percentage of interest. And then there, of course, is cash as another bucket. There are others. There's real estate and cryptocurrency and all these other things. But these are the basics if you're just starting out. And cash is liquidity. It allows you to buy things on a minute's notice. And so you might imagine that between owning pieces of a company and owning bonds, being a bondholder, that the safer investment or more conservative investment is bonds, because you have a contract to be paid the amount of interest and that you will get your money back. Not all bonds are created equal, right? There are bonds that have gone bankrupt and things like that, but there are insured bonds out there, or treasury bonds and other things that are backed by the full faith and credit of the United States government, which is some of the strongest credit in the world. And so you will get your money back, essentially. Moving right along here. The biggest thing you really need to do is master your fears, right? You need to have money invested in a variety of different things, right? In terms of what you begin investing in or anything else. You want to have cash for your short-term goals, savings accounts, money markets, even CDs. And then you want to have stocks and bonds for longer-term needs. So make sure you're selecting appropriate retirement plan investment options, managing your IRAs and your taxable investment accounts as well. And selecting your investments, you have to remember that there are things within your control and things that are out of your control, right? So you have total control over your spending and your savings, and your asset allocation and asset location, meaning the types of accounts that you're actually buying your investments in. You have some control over how long you live, if you keep up with your health and do all the right things, and apple a day keeps the doctor away type stuff, and how long you work, and therefore how much you earn and put away. And things that are out of your control, I would tell you not to focus on, right? So market returns are out of your control. Policy regarding taxation, savings, benefits, that's all really out of your control. Focus on what you can control. Mostly what you should focus on as an investor is your saving and your spending and your asset allocation and location. And that will be the majority of the way that you will win in the long run, focusing on the things you have absolute control over. So on that note, and because Stacy asked me to keep this to about 30 minutes, I will open it up for any Q&A that you all have. And I am happy to answer any questions. And I will actually, because I thought I had it on a chart, on a slide here, but I don't, I will post my contact information in the chat. And you guys, if you need to, you can just call me at any time or shoot me an email. We can set up a meeting. Yes. So I posted my info in the chat. Sure, if I can. Yeah. So I am veronica.karas@captrust.com, or my phone number is 516-238-0936. And I am happy to answer any one-on-one questions. If there's any question that someone wasn't comfortable posting here for any reason, I would be happy to answer it. Let's see if I can quickly add my contact information to a slide and re-upload this, actually. I'm putting my tech skills to the test right now in trying to do this, but let's see if I can. Let's see if I get there. I do. 1 second. I think I got it. There you go. So that's my contact information in case you all need it. Okay, so what are the advantages of having a donor advised fund for donating to charities? So the advantages of having a donor advised fund is you can take appreciated positions in your portfolio, move them to a donor advised fund. So you would save yourself the capital gain of selling them. In the year that you move them to a donor advised fund is the year you get the tax deduction. And then you can donate it to charities over time. So you don't have to make a donation all at once. You can keep the money in the fund and make donations over time. And that allows you to sort of take advantage of a large tax deduction if you wanted to. I hope that answers that question. What is the best tool to get out of debt? The best tool is your budget. You need to, and then coming up with a snowball rule to pay off your debt that has the highest interest first. And then over time, that will get you out of debt. But the biggest thing is your budget. Mint can certainly help with it and making sure you're on track. And then you need to make a list of all the debt you have and focus on paying highest interest first. So you want to go highest interest rate first, all the way down to lowest interest. Come up with a set amount of your monthly budget that you will use towards paying off debt, and also make sure you're not adding to your debt. Another thing you can do if you have debt is call your credit card companies or anywhere where you have debt, try to negotiate the interest rate or get a temporary freeze. So again, you can dedicate paying your funds towards whatever it is that has the highest interest rate. That answers that question. Any other questions? Oh, are permanent life insurance a good investment? No, they are not a good investment. Life insurance covers your life in the event that you may pass. All life insurance, permanent or term, is essentially a term life insurance policy with bells and whistles. All of those bells and whistles, like the ability to build cash value in a policy or anything else, come with fees, usually exorbitant fees. What a life insurance company does is they take your money and they invest it, usually into fixed income products. And you can instead choose to invest it on your own and avoid all of the fees. So I do not think permanent life insurance products are a good investment. What they are is a good forced savings vehicle. So if you have issues saving money and you need life insurance and there's no other way around it, you saving money other than having a bill to pay to an insurance company, that's the only way you can stash money aside, then that might be an option for you. Any more questions? For someone who is 50, is it wise to invest more in stocks than bonds as a way to catch up? That's a loaded question because it would really have to depend on your tolerance for risk. I would say everyone needs some stock exposure because that's where you're going to get long-term growth. But you may want to balance it, because if the amount you have in stocks would make you freak out and pull the plug with the money, when the market goes down, then it may not be a good idea. But most people need some, or almost everyone needs some allocation to stocks to make sure that they can support their lifestyle over the long term.
Veronica, I see two questions here that came directly to me. How does it work meeting with a CFP? Can it just mean having one visit to review my investments and paying a one-time fee?
Yeah, so the answer is yes. It depends on the CFP. So I'll tell you, I do all upfront analytics and meetings with everyone and put together full financial and investment plans for all people that I meet with before they become clients, because I want to make sure it's a good fit and our fees and everything else makes sense for that person's life. So if you're just looking for someone who's going to put a financial plan together for you, you could probably get it for free, from me certainly, but from others as well. If you're looking for ongoing sort of financial advice and management, then that's, we can certainly do that as well. And there are definitely financial planners that do one-time putting together a plan, no implementation help or anything else, and charge a fee for that. That definitely exists.
What is a good strategy for balancing paying off student loans and saving for retirement?
So it depends on the rate of the student loan. So let's say if your student loans are at a rate of like 3%, you can easily out earn that by investing. So including into your retirement. So you would want to put aside as much as possible into that. If your student loans are at a 6, 7, 8, I've seen 9% rate, you'd want to get those paid down as quickly as possible because those are rates that are really hard to out earn. It's a similar concept with like a mortgage. If your rate is really low, don't rush to pay off your mortgage. As long as you can easily out earn it with investing. In terms of in general, I would say everyone should target saving at least whatever they're getting as a company match for their company retirement accounts. If you can save more than that, you definitely should. And a good savings target, if you're starting in your 20s or 30s, is probably around 20%. If you're starting saving later, it's higher. So hopefully that answers that. I got a message here on what are your thoughts on investing in real estate? So I think investing in real estate is great as long as your rate of return on buying the real estate is at least 6%. Otherwise, I think it's not worth the headache.
It looks like
Hopefully.
you got all of them.
Oh, cool.
Yes, I don't see any more coming in.
Perfect. Like I said, so managed to figure out how to get my information on the screen. So if anybody has questions they did not want to ask in a public forum, I'm happy to answer them. Please feel free to reach out to me at any time. You also have a member here that I work with, Stacy Siegel. You can certainly reach out to her as well.
Great, thank you.
Absolutely, my pleasure.
Well, thank you everyone for joining us today, and a special thank you to Veronica for such an informative presentation. For her complete bio, please go to www.stjohns.edu/APD series. Here you will find a schedule of upcoming webinars and past recordings. In the meantime, have a wonderful evening. Thank you, Veronica.
Thank you, Stacy. Have a great evening, everyone.